Satoshi's breakthrough, the singularity of Satoshi was the idea that perhaps by knowing a secret, if the secret was a private key that gave you access to a monetary network or a piece of a monetary network, then you could hold wealth in your head. And that solved a problem that the pharaohs couldn't solve. How do you take your money with you? It's basically economic energy that you can carry with you to the grave, that you can control, that no one can take from you.
Without further ado, everybody, please welcome Executive Chairman, of course, of Strategy, Michael Saylor, and our interviewer, Thareem Maudji. You guys are wired?
We're all set. Thanks, Jack. Welcome, Michael.
Here we are. A lot of orange in the room. We appreciate that. It's the orange state, orange room.
So, Michael, you've said we're living through the greatest monetary transformation in history. What precisely is changing in global finance?
You know, if you trace the arc of human history, right, we use lots of things for money. We use seashells, we use glass beads, we use copper tokens, we use gold coins. We use all sorts of credit networks. If you think about capital, that is long-term economic energy, wealth. In the 20th century, capital was either equity capital markets, so private equity and especially public equity. And the money, the long-term money in equity capital markets is the Vanguard 500, which became the S&P 500, became the S&P, the equity index. And then you have real estate capital, New York City, London, the Gulf Coast, Florida, right, the West Coast, scarce desirable real estate, and you know, that drove the mortgage industry and it drove the commercial real estate industry. And then you have fiat capital, sovereign debt, and credit, and then you have corporate debt as capital. Do I own corporate shares? And if you're wealthy in the 20th century, you owned a sports team, a trophy asset, equity, private equity, public equity, maybe some bonds, a lot of real estate, most likely, and a little bit of art. So that was the capital markets in the 20th century. Now we have digital capital. Satoshi's breakthrough, the singularity of Satoshi was the idea that perhaps by knowing a secret, if the secret was a private key that gave you access to a monetary network or a piece of a monetary network, then you could hold wealth in your head. So for the first time in human history, we could tightly bind economic energy to the individual or the corporation through something that they knew. And that solved a problem that the pharaohs couldn't solve. How do you take your money with you? It's a problem that you would like to have solved if you were a Protestant in Catholic Germany or a Catholic in Protestant North Europe, or if you were Jewish anywhere ever in the history of the world, or if you were a Muslim when the Catholics took over, or if you were a pilgrim or a Puritan, or if you look at the entire history of the United States, it was always some group of people fleeing some other group of people pursuing property rights. And the one commonality in human history is there's 100,000 incidences of one group fleeing another group, and it's very difficult to take your money with you. Very, very difficult. You can't take the building with you. You can't take your stock portfolio with you. If you get out of favor, let's take Roman Abramovich, got very out of favor. The West took his sports team, took his buildings in London, took his villa in the south of France, seized his yachts, impounded his equity portfolio, impounded his bond portfolio, took all of his credit instruments, and the only thing you have left is your Bitcoin, right? Which is interesting. So what is Bitcoin? It's basically economic energy that you can carry with you to the grave, that you can control, that no one can take from you. And so the inflection point is the point where you could own something without the permission of someone more powerful than you. And that's an inversion. And it's an inversion of property rights. It's a singularity. It's a revolution. It's a paradigm shift. And of course, it starts as this ideological paradigm shift. Am I libertarian, or am I an Austrian economist, or do I believe in freedom and the like? But what follows is the spontaneous formation of a global network, and that network right now has 750 million people that believe in it. The crypto industry has 400 million people that believe or hold some form of Bitcoin. It is a global viral protocol which is manifesting property rights and economic empowerment. So the digital transformation of money wouldn't be possible without the creation of digital property or digital energy. That is something conservative in cyberspace. That if I send you $1 billion of Bitcoin by transferring a cryptographic approval to you, I lose it, you have it. If I send 1 billion videos or 1 billion songs, I have it and you have it. Information is non-conservative, energy is conservative. The conservation of energy is necessary to create anything of substance, of matter. And so Satoshi marks the singularity where energy flows into cyberspace and then digital networks come to life. And what's the killer use of energy? In this case, the killer use of energy is something that matters, the creation of matter and the creation of capital. So we formed a digital capital network, if you want a simple semantic representation, call it digital gold if you like, but digital gold understates it so much. It really was the spontaneous creation of a network to move capital and the capital asset. Call it a bank in cyberspace, if you will. And a bank in cyberspace where you could put your money and store it forever. But the breakthrough is, how do I move capital through time and space? And it's one thing to take, what's the value of every building in Naples, Florida? It's one thing to move the value of every building from here to Tokyo in 10 minutes. That's interesting, moving money through space. But it's an altogether different thing to how do I move the money in time 100 years forward. So the transformation of economic energy through time and space, that is the big idea. And of course, it only works to the extent that people buy into the protocol. Like if I had English language and it had a word for everything, but only you and me spoke it and nobody else spoke it, the protocol's not so valuable. If that table uses Arabic numerals, but everybody else uses Roman numerals, right? It's a protocol that's 100 times better, but no one uses it. So Bitcoin is this viral protocol. It's spreading, and how important was it in 2009? Not very. How important was it when I got involved 5 years ago? It was like a $150 billion network. How important is it today? It's a $2.5 trillion network. How important will it be in time? Well, when it's 25 trillion or 250 trillion, all of a sudden it starts to be very meaningful. So I think we're very fortunate. We're living in a time where we have created digital capital. And now, what do you call it? Well, some people think of it as digital money. It's not money like a medium of exchange. It's money like a store of value. It's long-term capital. Some people call it digital capital. It's a long-term store of value. But the network itself is a digital network. You can move it around. And what's most interesting to me, I think, is in the last 12 months, we're like, what's the date? November 6th?
November 6th.
1 year anniversary from the red sweep. So 1 year ago, there was a red sweep, and one of the things that got settled was, is Bitcoin a digital commodity? Yes. Is it digital gold? Yes. Is it digital capital? Yes. Will the banking system of the entire world embrace it? Yes. All of those things were settled a year ago today with the red sweep. You now have the Secretary of Treasury, Scott Bessent, last Friday, tweeted Bitcoin's been running uninterrupted for 17 years. Right? That's the Secretary of Treasury. 4 years ago, people said, oh, well, basically we went through this evolution. Bitcoin is tulip bulbs. It's a scam. It's a criminal enterprise. That was the hyper haters. And then we got to well, I admit it's better than gold. It's better than everything else, but it's too good to be true. So the government's going to take it away from you. Right? We lived through that stage from 2020 to 2024. It's like, well, I get it, but the government's going to take it away from you because it threatens the establishment. It threatens the dollar. It threatens the banks. It threatens the United States. And that got settled a year ago. And what's happened in the last 12 months is the President of the United States said, we're going to be the Bitcoin superpower. We're going to be the crypto capital of the world. Secretary of Treasury says, we're not taking away from you. In fact, it's good for the dollar. It's good for the United States. It's good for the world. Not only are we not taking it away, we want to be the leaders and we want to own it. So I think this is a very exciting year because at this point, you can see the market spoken. You've got $2.5 trillion of economic energy in this thing. You can see that the political sentiment has shifted. The Overton window has shifted. And now we're not at the end of Satoshi's experiment. We're in the first year of institutional adoption of digital capital and everything that flows from digital capital.
So we've talked a lot about portability, store of value, ability to actually transfer wealth. What would you say is the opportunity for wealth creation associated with this?
Yeah, that's very exciting. I think, so first of all, we'll just take some simple numbers, right? Like Bitcoin's been going up 50% a year for the past 5 years, 80% a year for the past 8 years. I anticipate it will appreciate about 30% a year for the next 20 years. So you want a simple number in your head. In US dollar terms, 30% ARR for the next 20 years. When you get to the out 20 years, probably you're 20% a year. So the terminal velocity of this thing is 20% ARR, 20 vol type asset. Think in that terms. Now, once you think about that, you put yourself in the position of, I'm an individual, I'm a corporation, I'm a government, how do I cash in on this? Well, I joke about it, but it's a simple mnemonic. If you want to 10x your money, you just buy Bitcoin and wait. If you want 100x your money, you buy Bitcoin with somebody else's money, right? And if you want 1,000x your money, you buy Bitcoin with someone else's money, and then you lever that. Right? And so what does that mean now? Well, you can simply just take your long-term portfolio, which is probably divided between equity and some bonds and some real estate, and you can start to allocate some to digital capital. And the portion you allocate will grow 30% a year, and what is real estate's 5, 6, 7% a year. The S&P is like 14% a year. Gold's about 14% a year. Money market funds are giving you 2% after tax, or about 2%, less in Europe, a little bit more in the US, but on a tax basis. So you're not getting rich by holding money market funds, for sure. So you could just allocate some or all to digital capital. But if you knew that something was going to go up 30% a year, then that means that any money you can borrow at less than 30% a year is going to be accretive, right? So you could, you can just go ahead and take a mortgage on your house, draw the money out of your home equity, buy Bitcoin. You're paying 5% or 6%, or When I first suggested that, people thought I was crazy, and the mortgage rate was 2.75%. So. Right? If the government wants to give you a subsidized mortgage, then you just draw down debt against a long duration real estate asset, and you invest it at 30%, and you scrape the difference, and that's kind of not that complicated. It turns out that the most creditworthy organizations are companies. Right? So you want to make a lot of money, you form a corporation. Corporation's a great wealth creation vehicle. So if you're a private company, how do you do it? Well, the world's full of people that have to buy private equity. So instead of raising $5 million to launch your whatever company, raise $50 million and put $5 million in the company and $45 million in Bitcoin. And the average company is growing 1%, 2%, 3% a year. And the $45 million Bitcoin component is a digital monopoly growing 30% a year. right? The VC will give you the money because the VC want to buy preferred equity, in a private organization. So if I had a private startup, I would just overfund it and I would capitalize the treasury in Bitcoin and raise more, right? You raise $500 million in capital, you buy Bitcoin, you have a $500 million business. It's monopoly, growing 30% a year. If you do nothing the rest of your life, you're going to be a mega billionaire. Actually, you probably only need to raise about $20 million to be a billionaire. If you raise $20 million, put it all in Bitcoin and wait, you'll be a billionaire in 10 years at the rate it's compounding. So not complicated, right? Let me say it a different way. You can raise money to launch a restaurant or a hotel chain or one of 18,000 software companies, and they're all very competitive businesses, or the next one of 5,000 banks or 5,000 insurance companies or whatever you want. The failure rate on a business is 95 to 99% over a decade. Eventually, if you're not Microsoft or Google or Amazon or Meta, if you're not a digital monopoly, you're running up against them. 27,000 retailers fail. Walmart powers forward, Amazon wins. That's the story of retail, right? Hotel. Every hotel company is a failure, right? Marriott doesn't own hotels. Four Seasons doesn't own hotels. Hilton doesn't own hotels. They all have management contracts. Why? Because the hotel business doesn't make money, right? Restaurant, McDonald's is a REIT. They don't run restaurants. Their business consists of getting other people to invest in the restaurant because they know it's not going to work. You're a software business, you're competing against Microsoft. They have monopoly. Microsoft's more powerful than the United States is. You could more easily leave the United States than you could exit the Microsoft network of your corporation. It's sad, but true. If you have to choose between American citizenship and giving up your passport or getting cut off by Microsoft, and once you look down at your Apple phone and figure out whether you're more afraid of being kicked out of Florida or having your iCloud account canceled by Tim Cook. Think about it, right? What happens if Apple just says, we canceled you? You'd rather be canceled by any city, any state, or any country than be canceled by Apple if you have an iPhone. So if you're running an operating business, it's very, very difficult. So what do you want? You want a monopoly. You want a digital monopoly. Okay, Bitcoin is a digital monopoly. It's a digital monopoly on money. It's the most powerful digital monopoly. So anytime you buy Bitcoin, you are merging your company with the digital monopoly growing 30% a year, unstoppable, that's global, right, with no attack surface. So if I'm a private company and I'm small, I want to raise venture capital, capitalize on Bitcoin, and then bolt it to the balance sheet. If I'm a big private company, I want to sweep my cash flows into Bitcoin because your big private company is growing 0 to 5% a year and Bitcoin's growing 30% a year. It's not complicated. You can either take all your cash. By the way, what do companies do with money? They give it away. They give it back to the shareholders, right? You can give your cash away via stock buyback. You can pay a dividend, or you can put it in a money market instrument that yields 2%, or you can invest it at 30% plus, tax deferred forever. Which of those makes the most sense? Corporate finance, and this applies to public and private companies. The conventional corporate finance theory for the last 50 years is, I want to run on minimal working capital. I want to buy back my stock, lever up, probably pay dividends, and if I have excess capital, I put it in treasury bills, short-dated ones, between 0 and 3 years out. I don't want to gamble the corporate money on equities. I don't want to buy long bonds, etc. I want to run working capital light. And if I do borrow money, I want to borrow the minimum amount. So that's corporate finance. And what does every big bank do? Every big successful bank, they beat earnings estimates, they raise their dividend, and they announce a bigger buyback. Everyone. Citi, JP Morgan, B of A, et cetera. What does every big tech company do? They beat earnings, they raise their buyback, they announce a dividend. Huh? Every well-run company in the United States is in the business of surrendering capital. Think about it. Here's my suggestion for your family. You have a lot of money, and you have it in stocks, and they go up and they down, and it's volatile. So why don't you just give all your money away to charity and have nothing, and your family net worth will not be volatile anymore. You see how stupid that is? It's literally the most moronic suggestion. Give all your money away and your family's net worth will not be volatile anymore. That's what companies do. That's what public companies and especially public companies in the United States, that is the corporate playbook they teach you at Harvard or Stanford or Yale. And think about it. It's just literally the stupidest thing imaginable. NVIDIA became the greatest company in the world. They'll generate $300 billion in cash flow. How many companies in the history of the world have done that? One. How many companies are there today? 400 million. You're the most successful company out of 400 million companies. You generate $250 billion in cash flow in 3 years. And what is your finance strategy? Give it away. So what? So you just won the lottery, 1 out of 400 million, and you're going to give away the winnings, and then you're going to roll the dice again, hoping that you're again the 1 out of 400 million. Now you've got to ask the question, why is Xerox gone? Why is Kodak gone? Why is Intel in trouble? The company I worked for when I started my career was DuPont, right? It turns out in like 4 years, my own company created 4 times as much value as DuPont is worth. And when you look at it, DuPont gave away more capital in dividends and buybacks than they're worth today. Right? And Intel gave away $100 billion of capital, and now the line is, well, we can't afford to build a chip fabrication or compete in the AI industry. Why? You gave away all the money. Okay? Corporations are like type 2 diabetics. Sorry, type 1 diabetics. A type 1 diabetic is someone that cannot form fat cells, so you can eat yourself to death. And a corporation that surrenders its capital via dividends and buybacks as fast as it can becomes a Toys R Us, becomes one of the 19,000 bankrupt companies that are roadkill on the information superhighway. They cannot store economic energy. What is your life expectancy if you cannot store energy, right? It's weeks, months. The reason the companies last 10 years or 15 years on average, it's not because they're defective ideas. It's because they don't have any capital. They decapitalize as a process. So how do you make money? Well, if you want to make money, I'd say first you start a company. It's obvious. Second, you raise, remember I said buy Bitcoin with somebody else's money? Raise capital. Raise venture capital, equity capital, private equity. You have something you have 20 million in cash flows. Well, go to a bank, get a $100 million loan, buy 100 million of Bitcoin, let it appreciate 30% tax deferred. You'll have $10 billion of capital by leveraging the 20 million of cash flows, right? Or you can just take the 20 million in cash flows and give it away as dividends, and you have nothing in 10 years. Or you can invest it in money markets, and the money is losing 7 to 10% of its value a year, and you're getting 2-3%, so you're like minus 5% at best. The cost of capital is 14%. That's the S&P index. So if you're not accreting capital faster than 14% a year, you're getting poorer. You're not getting richer in real wealth terms. And you can judge that, an acre of land in Miami Beach was $10,000 in 1930. It's $10 million today. That's, someone's telling you, right, 2%'s enough. It's not enough, right? I mean, think about 10,000 to 1,000x more expensive in 90 years, right? That's 7% a year, by the way, 7-8% a year, so that works out. So I think if you want to make money, right, as a corporation, if you're private, you find a way to raise capital and you buy digital capital with it. And as long as you're paying less than, if you're paying 10% or less and investing it at 30%, you're capturing the 20% spread. It becomes a finance exercise of how much capital can you raise and under what terms. By the way, good capital, equity. Equity is forever money. Preferred equity that has a dividend is Macaulay duration of 10 to 20 years. That's 10 to 20-year money. Debt that comes due in 5 years is 5-year money. A margin loan is 1 week money, 2 days, 3-day money. You go on a crypto exchange and you lever up 30 to 1. That's a flash loan. That's 3-minute money. Like you can literally be you could have $1 billion of capital in the market and be forced liquidated in 3 minutes. So when you think about this, not all leverage is equal, right? Having the money for 20 years versus having the money for 20 minutes is different. A lot of crypto bros, they want to go and lever up 10 to 1, 20 to 1 and catch the dip and ride it up. And it's not the wrong idea. The problem is their capital is 10-minute capital. And it's very seductive because you can have $1 billion of capital if you want to get liquidated in 10 minutes. Having $1 billion of capital for the next 100 years is a little bit more difficult, right? It's more challenging. So I think you want a company, there's a hierarchy, right, of these things, right? I laid out the hierarchy of capital from flash loans to permanent equity. What's the hierarchy of companies? Family business, partnership, private, small private company, big private company, small public company, mid-sized public company, big public company, right, in the U.S. capital market. And every single step up, right, you create a vehicle that can create more wealth. If you had a $500 million business holding slow real estate, I would say, well, bolt on $500 million of Bitcoin, wrap the thing together, take it all public, sell the equity, right? And now you've got a digital real estate business, right? You're creating value by creating growth and volatility, and then also liquidity in the equity. And those are all things that are possible. Maybe I should change subjects to maybe the most interesting new developments, right? Because Bitcoin is digital capital. I'm describing all the ways you can capitalize. You capitalize your private fund, your private company, your public company, et cetera, your endowment. You can capitalize with digital capital. It's going to outperform the S&P by a factor of 3, right? That's very simple. But the other things that are paradigm shifts right now are digital credit. For 300 years, the Western world ran on gold-backed credit. All the sovereign debt from France, Germany, the UK, it was all gold-backed credit. The currency, the United States currency, $20 to an ounce. The US dollar was gold-backed credit. US bonds were gold-backed credit. So that's the status for 300 years in the Western world. Now we're moving to a world of digital gold-backed credit. Digital credit. So what does that mean? If I know that Bitcoin's going up 30% a year, I can sell you a credit instrument that gives you 10% dividend yield. I can over-collateralize at 5 to 1. I can strip 95%. A lot of people aren't sure whether Bitcoin's going down 10% in the next year, but the likelihood it's going down 90% in the next year statistically is 1/100th of that. I can strip 99% of the risk off the instrument by over-collateralizing it. I can hand you 10% of the yield. I can keep the other 20%. So you issued credit, which meets the need of a credit investor. And then you get the capital back. The credit is long duration. Like when we sell a credit instrument, we could sell $1 billion of a credit instrument. The creditors give us $1 billion. We give them back $100 million a year. We buy Bitcoin. It goes up 30%. We generate $300 million a year in operating income tax deferred. It compounds. We end up with $10 billion on the back end. You're looking 10 years out. We have $100 million of dividend obligation. We make $1 billion up front. We make $9 billion on the back end. We make $10 billion by selling. Think about this. You sell $1 billion of credit, you just made $10 billion. Think hard about that. What other business can you sell $1 million of a product and make $10 million? Right?
Michael, let me ask you a question.
Yeah.
We have about 5 minutes left.
Sure.
The number 30% has come up a lot.
Right.
In terms of 10-year annualized return. Can you talk a little bit about what assumptions are built into that? 30% is a fantastic return. You're doubling your money every 2 1/3 to almost 2.5 years. So talk about what has to happen in order for people to make 30% a year.
The reason that people don't have appreciation is because the capital they're invested in is depreciating or decaying, right? So think about every way you ever lost money in an investment. The warehouse caught fire. NVIDIA gets banned from China. Apple gets sued by the EU. Microsoft gets sued for antitrust. COVID lockdowns destroy your hotel. People don't come to your restaurant. The mayor reroutes the traffic around, your business district. A crooked CEO takes over and loots the money. You invested in the world's best business in Argentina and the currency collapse. You own a monopoly on Russian bakeries and the war takes place. Trade wars, tariff wars, acts of God. All of these things are degrading risk factors to physical capital or to equity capital. Bitcoin doesn't have them. It has no counterparty risk. It doesn't. There is no CEO to rip you off, right? There is nothing in the real world. So the reason that Bitcoin outperforms the S&P index is because there's 50 pages of risk factors for every company in the S&P index, and we strip them all away, and we just keep the raw asset. The reason it outperforms gold is because gold inflates at 2% a year, and Bitcoin inflates at 0% a year. You might think that's a small number. The difference between 2% inflation and 0% inflation is the half-life of your wealth at 2% is 36 years. The half-life of your wealth at 0% is forever. It's the difference between you'll live 70 years or you'll live for 1 billion years. 2%. When people tell you 2% doesn't matter, it matters a lot. So the real breakthrough of Bitcoin is it is perfect money. It is the first perfect commodity which there's zero inflation, without the attack surfaces of a corporation, without the physical presence of a building. You want me to tell you every single way you can lose money investing in real estate in New York City? Who just got elected mayor? Think about it. What happens when the politician decides to rent control your building and then just maybe they'll just take it? The nicest hotel in I think in Cannes was the brainchild of a great developer, and he managed to finish the hotel in 1913. In 1914, a war broke out. The French government seized the hotel, turned it into an army hospital. The guy went bankrupt, died destitute. Oops. Don't want to own something that's desirable at the point when someone more powerful than you wants to take it away from you. And that's pretty much the story of most things. So Bitcoin is all the good things about property without all the physical liabilities, all the good things about a monopoly. What do you like about Apple and Google? They're monopolies. What does the EU not like? They're monopolies. The EU, right? The point is the Chinese don't like that. You think the Chinese want an American monopoly operating in China? Right, so the problem with monopolies operated by human beings is you can subpoena them and you can arrest the CEO of the monopoly. And by the way, it's illegal, right? Monopolies are illegal, right? If you form a cartel and restrain a trade to cut, if you actually organized all the gold miners and they all agreed they just stop mining gold forever, that's illegal. You go to jail. How do you actually create a scarce desirable asset on a global basis that's not illegal? You need to create a protocol, and you need to instantiate the protocol virally without a counterparty or a company involved. So Bitcoin just happens to be a perfect monetary protocol that was spawned by an immaculate conception, and as such, it's always going to outperform other capital assets because it has none of their defects. Right? It just, you've stripped away. The idea of Bitcoin is what? I want to own 1/21 millionth of all the money in the world forever. Okay, tell me the problem with that idea. You want to own 1/21 millionth of all the money in the world forever. When will that be obsolete? 10,000 years ago, people were murdering each other to own the money in the world. 10,000 years from now, they'll still want it. So, I'm on the iPhone 17 Pro Max, okay? The second best idea has gone through 37 different iterations, right? It obsolesces. But 1/21 millionth of all the money in the world forever? That will outlast every country. That'll outlast your language. That'll outlast every company. So we can differ about, you might not think 30% is the right number. It's my view based upon all the statistics of the last 17 years. But what I would say to you there is, if you don't think it's the right number, I'm willing to do a swap for you. If you go by STRC pays 10.5% dividend yield with no volatility, and it's tax deferred. So you can have the first 10.5% risk-free, and I'll take the rest. And if I'm wrong, then you got 10.5% guarantee. And if you actually believe me, then you shouldn't take that deal, right? But as a practical matter, if you don't need the money for the next 4 years, you should buy Bitcoin. If you're industrious, you could create a company to raise capital to buy 10x more or 100x more Bitcoin. But if you're skeptical, then you should just determine whether Bitcoin's going to zero tomorrow forever. If it is, don't buy Bitcoin, don't buy anything related to Bitcoin. But if you think, well, it's kind of volatile and I don't know whether it's going up 10% or 20% or 5% or going down or whatever, then you just ought to go buy STRC because that's digital credit. That's a guaranteed 10.5% dividend, tax deferred. That's a tax equivalent bank account of 20% if you're a New Yorker.
Thank you, Michael.
Right? And so that's the big idea.
Thank you, Michael.
Happy to take questions from the audience if you guys
That's what I was just going to ask. Do we have a microphone, Jack?
Yes.
We can probably hear everybody, but small room.
Barbara?
Any other crypto, is it Bitcoin or explain that?
The way to think about the crypto industry is there are two sides to it. There's digital finance and there's digital capital. Digital capital means digital gold, long-term store of value. Okay, Bitcoin is one that. In order to have digital capital, you need a proof of work network that's energy intensive. Bitcoin is 99% dominant in that space. What's the killer use case of digital capital? Digital credit, right? Digital credit on top of digital capital, that will be a $100 trillion type side. There's another side to the industry, digital finance. That means moving stable coin, digital tokenized currency, tokenized security, tokenized bonds, tokenized real world assets, tokenized brands, Trump coin, meme coin, Katy Perry token, tokenized country club memberships, tokenized restaurant memberships, Joe Rogan coin, tokenized Apple stock. I mean, it's not all jokey. I mean, it's like $10 trillion of tokenized US currency. It's a serious industry. That business will be dominated by proof-of-stake networks. Ethereum, Solana, BNB are the big three, and there's a bunch of others that are competing. And the crypto exchanges, and that's in and of itself, there's $100 trillion of stuff to get tokenized. I don't know if there's $100 trillion of wealth that'll be created, but there'll be trillions of dollars of wealth created. When you're investing in that industry, you're a tech investor. There's some regulatory gray zone. When the market structure bill, the Clarity Act, gets passed either later this year or early next year, you will have bright lines as to what assets you can tokenize and what are the risks and then what are the opportunities. Right now it's in the gray zone. There's general political consensus that we should do it, that we want the United States to lead it, but it's really 100 different opportunities and they're all very competitive. And the question is, are we going to move $1 trillion of tokenized US currency on the Solana network or on the BNB network or on some other network? And, so I can give you investment advice the same way if you would ask me, what about the 500 companies in the S&P? Who are the winners? Who are the losers? I'm like, that's very complicated. Spend 100 hours studying each company and form an investment thesis. And I would say in digital finance, it's the same thing. The reason I'm waxing philosophical about Bitcoin is not complicated, right? There's a winning language called the English language. There's a winning math protocol. It's Arabic numerals, 0, 1, 2, 3, 4, 5, 7, 8, 9, right? There's a winner. There's a winning digital capital network. It's Bitcoin. There's a winning world reserve currency. It's the dollar. There's a winning superpower. It's the United States, right? There are certain winners. There's a winning metallic money. It's called gold. The gold standard. So it wasn't clear it was the winner 17 years ago, but after $1 trillion of votes and after hundreds of millions of people have decided, the smart money has decided that's the winner. Once you know there's a winner, like I'm telling you New York City is going to win and the year is 1750 and you have the chance to buy New York City at a higher price than anybody ever paid in the history of New York City, is it a good investment? And the answer is yeah. It's going to be a good investment every decade for the next 250 years, We'll see if it continues to be a good investment.
All right, so we have.
Let's
we're
go
gonna
one more question right over there.
Actually, we're going to go two more questions.
Ooh.
Two more questions, and then we have to clear the room. So, and then after that, we have a reception open bar at the in the lobby behind us.
Thanks.
Okay.
Hey, Michael, so much of Bitcoin's use as a store of value is currently driven by the halving mechanism to the block reward. A lot of the early talk in the Bitcoin Talk forums was imagining a world where there would be enough transaction volume so that miners would be competing less for the block reward and more for transaction fees. If and to the extent Bitcoin is and only is an immaculate store of value asset, at what point does that present some type of existential risk to Bitcoin mining activity on the network?
Yeah, there is no existential risk to it. I think that's not something to worry about. The 4-year cycles were meaningful for the first 12 years. They became less meaningful, by the end of the 16th year. Right now, you're talking about a halving that's coming that will reduce the supply of Bitcoin by $25 million a day. Bitcoin's trading $60 billion a day. 25 million is not even a second order issue. It's a third order issue with liquidity. So that the 4-year cycles have disappeared for all practical purposes because they're an order or 2 orders of magnitude less than the amount of capital in the market. With regard to the second point you make on security, the security of the network is because of mining. The hash rate of Bitcoin miners was about 100 exahash in 2020, and it dipped to 70 or 80 exahash in 2021 after the China lockdowns. It's 1,200 exahash today. It has increased by a factor of 10. The mining activity will continue to increase, and the hash rate is going to go up forever. And the reason it's going up forever is because the cost to mine, the hardware is getting exponentially cheaper. And so it's like, think about how much it costs to buy a 386 chip today, or a 40, it used to be there was a $300 chip, and then it became a 30-cent chip, and people put it in postage cards as a gag. And that's the same with Bitcoin ASICs. The hardware is getting exponentially cheaper. They're going to sell it at a dramatically reduced rate. And you would say, well, it doesn't seem like the miners are making much money. That's true, but restaurants aren't making any money, and hotels aren't making any money. And you know what? You can't make it. There's no successful person making money selling guns in the United States either. And yet somehow we have infinite restaurants, infinite hotels, and infinite guns. So think about that for a little bit. What is the market telling you? The answer is people mine Bitcoin with stranded energy and stranded capital. And that means there's a lot of money in the world that is stranded and it wants to get unstranded. And the people in China, the Chinese were mining Bitcoin because they had Three Gorges Dam, which generates 10 gigawatts of free electricity. And it's like, I can either use it to mine Bitcoin and monetize it, or I cannot, but I'm stuck with dams and they're not moving, right? So the world's 30% of the energy in the world is stranded. It's excess, and the only place to sell it is the Bitcoin network. But on the other hand, if you're Chinese or Russian or Ukrainian or Iranian or North Korean or Cuban or Venezuelan right now, how do you actually get money, right? Like at the end of the day, you're going to have Siberian natural gas fields, and they're flaring natural gas. They're going to convert into Bitcoin hashes. So no matter what the block reward goes to, the network is just getting more secure. It's a one-way ratchet exponentially up forever. It's like, one more point. Bitcoin's secured by hardware. If everybody in this room is a billionaire, you've got economic energy and I've got the gun, who's the most powerful person in the room? Me. The gun costs $200. When you actually use hardware to secure money, right, the cost of the security falls exponentially. I can literally stand outside the door with a $200 device, right, and depend $200 billion worth of money. What's going on with Bitcoin is they're using hardware. They're using the computer hash rate to defend the network. And there's always stranded energy and stranded capital. And after that, it's like, well, you think the United States will stop making guns if it's not profitable? I don't think so. Right? Why do we make guns if no one makes any money? The answer is because we don't want the enemies to shoot us. Right? So at the end of the day, Bitcoin will be mined by nation states, right? If I have $100 trillion of money on the network, you think I'm not going to actually defend the network? Of course, I'm just like the bank has a guy making minimum wage standing outside the bank with a gun, right? That's how you defend $100 billion in the bank, right? So the network's not getting insecure. The network's getting more secure for a bunch of different political and economic and physical reasons. It's a thing of beauty, because how are you going to defend $100 trillion of capital using computer power that gets exponentially cheaper, right? Satoshi discovered it, and we're the beneficiaries of it.
Okay, wonderful. All right, one last question, and then Michael is going to stay with us for the reception for a little while, so if you have any other questions, maybe you can grab him one-on-one at the reception. Madison.
Hi, Michael. I wanted to talk about Satoshi's 1 million coins. Some people have been talking about them as a security risk. Do you see any scenario where those coins being moved or not moved actually impacts Bitcoin's integrity?
No, I'm not that worried about that. I don't think they'll move. I think generally they mention that in the context of a quantum threat. If sometime 10, 20, 30 years out, there's a quantum computer that's powerful enough, we'll upgrade the software and upgrade the hardware and upgrade the nodes running the network with quantum-resistant algorithms. When that happens, people will address the issue of what they do about Satoshi's coins. And again, it's like, if everybody in the world had their money in a bank, and it turns out that there was 5% of the money in the bank that was left by an account of a long dead person, you think the people with all the money in the bank would figure out how to deal with the account? I think they would. Right? I think in this particular case, there won't be a problem generating consensus when there's a genuine threat. So Bitcoin's all the smart money in the world, right? All of the smart people that are rich in the world that wanted to put their money in cyberspace chose Bitcoin. The smart rich people will figure out the solution because all the money in cyberspace depends on it. Everybody else will worry about it, but they won't have any money, so what does it matter? Yeah. Yeah, thank you.
All right, all right.
Thank you, Michael.
Thank you, Michael. Thank you, Kareem. Thank you, everybody, for enjoying this wonderful day with us. Naples Symposium moves on out to the reception phase of the day.